Thank you very much. Hello and welcome to this Financial Advisor IQ webcast. My name is Nick Reeve. I'm a financial journalist with Brandt Media, and I'm your host for today's session. Now, for wirehouse advisors, the promise of improved flexibility and ownership has long been a draw towards going independent. It's important to note that these benefits can extend to your client base as well. So our trio of panelists are going to talk us through some of those benefits and how a move to independence can help financial advisors offer more value to their clients. So I'll quickly introduce those panelists. First up is Jeff Boudjouck, Managing Partner and Wealth Advisor at Northeast Investment Group. Jeff is founding partner of Northeast, having previously worked with UBS and Morgan Stanley. We've also got Keith Brandt. Keith is President and founder of California Wealth Transitions, which he set up with his wife Nikki in 2012, having previously worked for Merrill Lynch. And finally, we've got Scott Wilson, who is Senior Managing Director and Chief Operations Officer at Kestra Private Wealth Services. Can you summarise briefly the number one benefit that your clients have experienced from you going independent?
Well, I think one of the big issues for our clients, at least, was the issue of costs. And so, at the wirehouse, there's a little bit of flexibility in terms of what your client costs, what your clients pay for your services. But for the most part, the firm sets the program, they set the fee schedule, and then you have some limited ability to discount that. When you're independent, it's kind of interesting because you can set your fees at whatever you want. Now, the difference is if you drop the fees, that drops your compensation. But if you're keeping 60 or 70 or 80% of your revenue, that gives you a lot more room to reduce your compensation versus at the wirehouse, you're getting, maybe 40% of your compensation. So you're a little more reluctant to reduce costs for your clients. So for our clients, we pretty much told all of them that at the new firm, your costs will be the same or lower than they were at the wirehouse. And it's really nice to have that be pretty much up to you to decide how to do it.
Okay. And Jeff, what would you say was kind of the number one benefit for your clients?
Sure. I appreciate the question. So for us, it was to be able to tell our clients that we are truly their fiduciary. Coming out of the wirehouses back during the battle of the fiduciary rule and whether that was going to be expanded upon wirehouse employees. I would tell you that most wirehouse advisors thought they were fiduciaries, believed they were fiduciaries, but clearly we were not. So for us and for our clients, the move to independence was to be able to position ourselves truly as their fiduciary in all senses. And it comes up in just about every conversation we have with a new relationship, never mind, a current client of ours as we transitioned out of the wirehouse.
Thank you. I'm going to turn to Scott now. Scott, what's your views on that? Is that typical of the advisors that you work with, those kind of benefits?
Yeah, absolutely, Nick. I think both those comments from Keith and Jeff are top of the list. Certainly, choice, it's really the theme of choice. I think that advisors, when they leave a more proprietary sort of environment and go independent, they enjoy the freedom of choice. And that's on a number of fronts that we can dig into later. But being a fiduciary, having freedom of pricing your clientele and your client base the way that you think it's appropriate, if it's technology, your platform, pricing, whatever it may be, that's the biggest thing that we see across the board with our advisors when they leave a wirehouse.
Okay, well, let's delve into that fiduciary point that you raised, Jeff. What is it about that clients find so appealing, and how was that? Can you describe the transition from the wirehouse to independence in the context of fiduciary status?
Sure. I think clients they want to know you're serving their best interest. That both not just verbally but legally, that you're looking out for them. Whether it's with the investments you're recommending, the financial plan you're reviewing, the strategies, the fees, whatever it may be, that you're putting their best interest first and foremost ahead of that of a major Wall Street firm that carries certain other priorities, perhaps. Our firms are owned by us. They're not owned by some major enterprise, some major firm in New York City or abroad. So for us, once again, it was to be able to position ourselves as being truly independent, being your true fiduciary. We're not naive. If any of our clients watch CNBC, there's a commercial running every few minutes talking about a major firm that serves as a fiduciary and how that is important. Our clients aren't naive to that. They realize that, they see that, they want that. So for us to be able to present ourselves and be able to tell our clients that we serve as their fiduciary, that once again, we're legally bound to always look out for their best interests ahead of ours or the firm, our firm, is hugely powerful and gives our clients the peace of mind that they should all expect when working with a financial advisor.
Jeff, I would add that I think that because of the press, a lot of people know about the fiduciary issue now. So prospective clients, they'll ask us, "Are you a fiduciary?" And when we were at Merrill, we would explain to say, "Well, no, technically we're not a fiduciary, but we act as one in this way." So you're always sort of explaining around it. And when you're independent, you don't have to say, "Technically we're not a fiduciary." You can just say, "Yes, we are."
I agree 100%. You're spot on, Keith.
Scott, did you have any views on that? What was your kind of take on that?
I think, what Keith and Jeff mentioned are spot on. I think we don't beat around the bush from, at our firm. We hit it straight on from day one that we expect our advisors to act in a fiduciary capacity, and we manage the business along those lines. All the decisions that we make from a platform and really what's in the best interest of the client, that's what drives all the decisions when it comes to making the platform and products and services available for the advisor. And it's all about the client. Not that it isn't at a wirehouse. They certainly are focused on the client. We don't want to give you that impression. But I think from a legal and from a position of setting up how we manage the business, we attack it from that angle first. The clients comes first, and the advisors are acting in the best interest of the client. So as Keith said, there's no beating around the bush on that. We don't have to skirt that issue. We hit it straight on. And I think once advisors get out into that environment, it's a relief. It takes that off the table, and they don't have to worry that they're saying the wrong thing to the client. So it's been a real positive.
Yeah, it becomes a position of strength rather than a position of weakness. And once again, prospects know it, clients know it. It's not something that is unknown, the concept of being a fiduciary or not being a fiduciary. I don't think us as advisors can kid ourselves of how important that is to them.
Great, thanks very much. Well, we've got a couple of questions already coming. Oh, sorry, carry on. Yeah.
No, I was just going to say, the larger the client, the higher the net worth. There are a number of corporate clients that really expect that, and so it has been a very good thing, specifically in the high net worth space. From that perspective, we don't have to skirt that issue, and certainly it's been a positive.
Now, Scott, in your opening remarks, you mentioned the importance of choice as kind of the broad theme, and I think that's going to be a broad theme of our discussion. We've had a question in asking to expand a little bit more on the choices available to you as an independent financial advisor. Who wants to kind of jump in on that? Can maybe an example or two of how that expanded choice can help your clients?
I might make a couple comments, and then Jeff and Keith, you can talk specifically. But I think in a broader, the areas, certainly technology and software, there is significant difference of choice. And most advisors are able to go best of breed and really outside a set platform where they don't have choice. That's a biggie. It can be, a number of things on the platform. If it's performance reporting, the CRM that they use, the quotes that they receive, the research that they are able to participate in. It may be on pricing. You have significant choices, Keith said, on how you price your clients, because you know your cost of goods sold, and you run a business and you appropriately price that business for your client base, and you're not subject to minimums. So I think those are the overarching categories, and maybe Jeff and Keith can delve in from their perspective.
I would add, it's such a different world, right? In addition to products and services, you've got choices on your employees, right? You don't have the wirehouse saying, here's your support staff, and maybe you're sharing them with other people, maybe you're not, but it's totally up to you. So you can decide who you want to have work for you and who you don't want to have work for you. So that's a very freedom thing, whether it means support or even other advisors you want to work with. So that's a big amount of flexibility. And then, back to the pricing thing, that it's all up to you. So that it's just nobody's telling you what to do. For some people, they like being told what to do, but in the independent world, nobody's telling you what to do.
Yep.
So I would agree with what the guy said. Specifically, we saw it with our CRM. We came from a major firm that tried to reinvent the wheel when it came to the CRM, and I can't think of one advisor that found that to be a fun experience. So something as simple as what you want to use as a contact relationship software provider, who you want to use for financial planning, is just, once again, it's entirely up to you as a business owner, as an independent advisor to decide, rather than being force-fed a solution from above. And just to add the concept of pricing, it also allows us to price things out. Once again, coming from a wirehouse firm, if you wanted to do something as simple as a securities-backed line of credit, you had to use what your firm told you had to use, which was an in-house solution. At an independent firm such as Kestra, we're able to go out into the marketplace and have various lenders compete for that business and ultimately provide a lower cost solution to our clients. Again, always trying to do what's best for our clients. I think that platform of being independent allows you to really compete more aggressively for the best interest of your people.
And I would add on what Keith said. There was, for instance, there's choice on what tax entity that you want to set up for yourself. We don't, you're not a W-2 employee. You're able to go out and set up whatever tax entity you see best for your personal situation, right? We have no dog in that fight. I think that side of it is extremely attractive. And as Keith said, you can employ as many support staff and partners as you want. You're not bound by the entity that you work for. You will set up programs and hours and wage structures and retirement plans and benefits that are in your best interest. So I think there's incredible flexibility and choice, even on the entity and tax side of it as well.
Nick, I just want to add one more thing, because Scott brought up an interesting thing in the world we're in today, right? This post-COVID world. I talked to one of my friends at the wirehouse this week, and they said, yeah, officially everybody's back at work, but it's sort of up to each manager to decide whether they force everybody to do that or not. And in many cases, they're being relatively liberal, but the policy is being set at the national level. So at our office, we basically went around to all of our employees and said, what do you want to do? So now we make sure there's one person in the office every day. But other than that, most of my people don't come into the office on Mondays or Fridays anymore, period. And I would say in general, people are here 1 or 2 days a week, and that works fine. And that's okay with us. Nobody is telling us we have to do something different.
I'm guessing that kind of then feeds into the technology discussion as well, of being able to have that, flexibility in your technology stack to enable remote working at a degree that perhaps wirehouses with regulatory, guardrails that they've got perhaps aren't able to do as much. Is that a fair summary?
I think certainly the independent technology lets you do that. I would say the wirehouses probably have the similar technology, although they're maybe not as anxious to make it work, right? So I've got a laptop at the office. I've got a laptop at my house in Montana. I've got a setup at my house in San Diego. So I've got 3 setups. I didn't have to get permission from Merrill Lynch to do that. And they really don't care where I am. I'm not sure at the full wirehouse that you could be quite that flexible, to be working in those different places. And they're going to be telling your support staff what they want them to do rather than you. And that's a big difference.
Something as simple as printing. The wirehouses, when we were there, sure, you can work from home from your primary residence, but something as simple as trying to print a statement for a client, or print a document, or print a proposal, was not something that you were allowed to do at the wirehouses. So, it seems like a slight difference, but something as easy as hitting a print icon was not allowed. Where, if you're working from home, whether it's because of COVID or you're doing some work over the weekend, getting ready for an appointment on a Monday or whatever the case may be, you have full access to the entire technology stack, the entire ability to print as need be. Once again, working in the best interest for your people.
Yeah, absolutely. We've been talking about fees quite a bit through this discussion. I want to kind of focus on that for a few minutes if we can. We're talking about the flexibility it gives you, and I wondered if we could perhaps delve into this in a little bit more depth, some examples of how that flexibility has been kind of has played out for you and has helped your clients.
So one of the things that we can do is sometimes clients will come in and say, I got all my money at Vanguard or my 401k or whatever, and I'm really pretty happy with how I'm managing my money, but I need some help planning. And so we've got a situation where we've got a number of clients where we say, fine, we'll just charge you an annual planning fee. And we can pick that fee whatever we want. It could be $2,500, it could be $10,000. And so they don't actually have any accounts with us. We just charge them a fee once a year to do planning for them. We also do a similar kind of thing for people that are going through divorce. We'll tell a client that we'll just help you go through the divorce process. We'll charge you a flat fee for that. After your divorce is over, if you wanted to become a client, that's fine. But if not, at least we're able to provide a service and that the clients wouldn't have access to otherwise and still generate some revenue. At the wirehouse, when I was in that situation, we might help the clients, but we couldn't charge a fee, so we didn't get paid. And the clients don't value that as much, right? If you're giving them free advice, they're wondering, well, what else is in it for them? So it's a little more transparent relationship, which I think the clients appreciate more.
And I see a number of things, Nick, from a pricing perspective. I know that Jeff has a fairly large relationship that's held away that they advise on, and that is he has he and his team have flexibility to price that relationship with the appropriate pricing that works for them. We also see a big difference in the industry because some of our firms do want to attack, maybe the millennial group of investors, and they would like to have the freedom to charge a monthly subscription fee, as an example, because those folks may not have large assets, but they want budgeting help and they want financial planning, or they may want term insurance and just to get going. We have the ability to, allow the advisors, they run their business, and if they deem that is an appropriate way to do business, they're not bound by minimums, household accounts. They can make a business decision, and if they want to charge them a monthly subscription fee, that's great. And we provide the technology that they can pay a monthly fee on their credit card. Right? Those are the types of things. The technology that's available today has really moved forward, aggressively. And in the independent space, I think the advisors have the ability to continue to step up with different partners, as long as it's approved from a cyber perspective, and we make sure that the client and that information is protected. We are able to provide those services for clients that they're really not able to from a large wirehouse, where they're not going to take the risk, I think, to provide those types of services across the board. So that was another example that we see today with providing services, for example, with millennials. That's an aggressive part of the business that we're doing a lot of business with.
Yeah. So my 2 cents of that would be just the concept of some of the smaller relationships that we onboard as a firm, as business owners. If we decide that relationship is beneficial, whether it's a referral, an introduction, a friend, a family member, or center of influence. When we left the wirehouses, those relationships were certainly frowned upon, were difficult to open. You need to justify the smaller households, or that the firms wanted these smaller households to be held at call centers, which once again isn't necessarily in the best interest of your client. Your client wants to work with a local advisor, but because he or she have a relatively smaller relationship right now, because they may be new professionals, or they're once again a center of influence, and maybe they don't have the larger resources of a higher net worth individual. They are still have the ability to work with you, receive the full service advice of a local advisor, develop that relationship, And maybe that leads to a larger relationship down the road, but ultimately you're able to serve the people as you decide to be appropriate without being forced to justify the relationship or have that relationship moved over to a call center, which once again I would view as not in the best interest of that person who seeks out local professional individual advice rather than, a 1-800 number, based out of, Tennessee or Utah for that matter.
I want to ask about 401k because we've talked kind of generally about planning, but on the pension side, I know personally from my point of view, I'd love some more advice on my for my pension that's not necessarily kind of accessible at the moment. How have you guys been able to bring that kind of advice on board into your offering?
So I'll take a shot first. One of the things that we find now for a lot of our clients and a lot of people, right? The biggest chunk of money they have is their 401k. If you look at people ages, 35 to 50, that's where all their money is. And that's in the company plan. And so, at the wirehouse, the better advisors might take a look at their 401k statement and give them some guidance about what to choose. The nice thing in our world, an awful lot of people have their 401k plan now. They've got options if they're with Fidelity or with some of the other firms where they can set up their own self-directed plan at TD Ameritrade or at Fidelity. So they literally set up an account there. Well, we can manage those accounts and we can charge a fee for doing that. And so it's a source of additional revenue for us. But what it's really great is for the clients, they've got all this money and they really want to have somebody help them manage it. And so it's a way that we can help clients manage their single largest asset. They're still in the company plan, but we can set up an account at Fidelity. We can tell them what things to buy and sell. We can manage it just like a regular account. And the client doesn't have to worry about that anymore. So that's a huge plus for clients to have their most important, biggest asset managed by a professional. It's supposed to sort of secondhand at the wirehouse. You say, well, you know what? Sell this fund and buy that fund. Well, that's not quite as easy as letting us just take care of it.
Yeah, I think it ties back into the concept of, of a holistic approach, right? I think all advisors at all firms ideally want to become holistic financial advisors and provide, full financial advice across all, areas of assets, whether they're held at our firm or held away. The format of being an independent advisor truly allows you to do it with avoiding conflicts of interest, with avoiding compliance issues or regulatory issues. Once again, ultimately, it's that fiduciary responsibility of trying to do what's best for your people. Our format allows us to do that with very few strings attached, which is truly tremendous for the client.
And I was just going to add to that, Nick. The beauty is with the technology today, you can aggregate data in, like what Keith said, if they have a 401k or a retirement account away, most firms allow you to aggregate the data into a portal to do asset allocation. You can also aggregate that data into a performance reporting portal to show clients the performance in totality on a holistic view of all their assets. And in many cases, they want to know, how is the performance of what I'm managing in my 401k, maybe in comparison to what you're doing for me on my account where it's held in custody and where you're the broker of record. So the tools today allow you to aggregate it for financial planning, for performance reporting, and you can do that for people that aren't clients, but people are willing to pay a fee that's reasonable, right? To get help with asset allocation, with financial planning, and really recommendations on the entire relationship. If it's on insurance assets, they may have variable annuities and they may have universal life and other assets that have market-related pools of assets that are being sort of ignored. I think independent financial advisors bring those tools that aggregate the data, and you can x-ray all of those assets across the board, show their asset allocation on all the sleeves of all their assets, and ultimately you can show value. And I think for the client, the benefit for the client is they ultimately feel a much better sense and comfort with that somebody's looking over those assets and they're willing to pay you a reasonable fee, right? And the advisor can choose a fee and they can set the pricing on what they deem to be appropriate for their practice. Nobody's telling them what to do. they are running a business. They're making business decisions based upon their infrastructure and their cost of doing business. And we love to see that happen and the freedom that brings in the independent space.
I would add one more thing, and I couldn't have done this at Merrill. So I have a couple of 401k plans, and the money's not with me. One of them's at Vanguard, one's at Fidelity, and they wanted somebody to provide employee education and look over their investment choices. And so they just came to me and I said, yeah, you know what? Here's how I'll visit you 2 days a year. I'll do a 1 day in-person meeting, and I'm going to charge you $25,000. They're like, perfect. So it's kind of like you just decide what your time's worth and how much you want to charge for that service. And the firm says, yeah, that's fine. It's not a commission-based arrangement. I didn't have to get anybody to sign off on it. I just said, here's how much I want to charge. And they said, yeah, that's okay. So it's a great thing for the client, because in many cases, their normal choices are to hire a firm who does a bunch of plans, and they don't get high quality education, right? Or they get some brand new advisor that's doing employee education that doesn't know what's going on. So I'm not inexpensive, but I can charge a fee that's worthwhile for me, and they can get maybe better advice than they might get otherwise.
It does come back to those kind of themes that we've been exploring of holistic flexibility and choice, but holistic approach, and that fiduciary importance as well. We do have a question outstanding about some examples about telling a client why being a fiduciary is better. And I'm interested maybe to come back to that fiduciary discussion now. Any examples that you guys can kind of bring to mind about, how you can kind of make that case to the client about the benefits of fiduciary?
Ultimately, it's again, to me, it's a position of strength. If you're able to tell a client you're serving as their fiduciary, which, textbook definition simply is, their interest ahead of yours. Would a client rather be served by an advisor who's a fiduciary or a non-fiduciary? Someone who is legally bound to put their interests ahead of that of their firms, or someone that is not legally bound to put the best interest of a client ahead of a firm's? I really think, not to water it down, I really think it's that simple. If a client had a choice, A or B, a multiple choice, and A or B were the two answers, work with a fiduciary, work without a fiduciary, I'm hard pressed to think why any client would choose to work not with a fiduciary when presented that option. Clients, once again, we may not realize it at times, but clients realize this. They're thinking of it. They've been hearing it now for almost a decade, going back to the fiduciary rule conversation with President Obama and then President Trump. They're lambasted with the commercials on TV nonstop. Once again, I think sometimes as advisors, maybe we lose sight of what clients are thinking. So if you put yourself in that client's shoe, would that client rather work with a fiduciary or not? I'm once again hard pressed to think why a client would not want to work with a fiduciary. That once again legally bound their interest ahead of that of the firms.
Yeah, and I think that it really is a matter of the client's perception and making them comfortable, right? If I'm at Merrill Lynch, I can set up a fee-based managed account on an advisory basis, right? I don't have any commission conflict. I don't have any other agenda. It's not any different than what I do as an independent. But if I'm at the wirehouse, I've got to explain that, versus if I'm independent, I can say, yes, I'm a fiduciary, right? So I wouldn't say that it may not be that big a difference in practice, right? I can do the same thing at both places, but it's very much a different position when a new prospect comes in and, they've got their list of questions, and quite a bit, one of their questions is, are you a fiduciary? So it's awesome to say, yes, we are.
I think it's about removing conflict. I think most advisors at the wirehouse do view themselves as a fiduciary, and really most act in the best interest, of the client, and do a phenomenal job. I think, as Keith and Jeff said, it's just that in the independent space, there is a significant amount of effort to remove all the conflicts that exist in pricing products. Really, it's a gray area, but we try to remove all the conflicts so that advisors are comfortable acting in that capacity, even if they're dual registered on both sides of the equation. They really do work very hard at removing those conflicts, and they show the client and give them the confidence that they're able to tell their clients in what capacity they're acting.
Scott, to come back to one of your previous comments, we were talking about technology. And as advisors go independent, you obviously want to build your own technology stack. So I wanted to talk a little bit about that and about how removing some of those guardrails that may have been in place on the wirehouse platform, how this affects the technologies at your disposal for clients. And to Keith and Jeff, examples perhaps of some technologies that you've used to bring in new capabilities. So Scott, do you want to kind of start off with how that?
Yeah, and Jeff and Keith, I'm sure, have a number of examples of different technology that they use if it's tax planning related. I think much of it, as you mentioned, there are just, working at a wirehouse, the reality is there are going to be guardrails to protect the firm. And they're generally speaking larger entities with 10 to 20,000 advisors. And the reality is they need to put guardrails in place to protect, the firm from somebody getting outside those guardrails, because you're talking about people that are from 1 month in the business up to 35, 40 years in the business, right? There's a much broader spectrum. But I would tell you there are, incredible technology every day is becoming available. Generally speaking, from performance reporting to financial planning to other aspects on, tools that help analyze risk, to platforms that help you execute more efficiently, that, data aggregation tools, right? All of the above, there are incredible tools available that you have the choice to integrate into your platform. Research-based tools, right? That's another big item that, having access to a broader spectrum of tools that help you make better investment decisions for your client. And I think this is all about the client. All these things are, if you give a better experience and clients have a quicker and easier way to access their assets. Clients want a portal. They want a way that they can punch an app and see their assets that are up to date, to the minute, and that they are able to communicate with their clients also in a more up-to-date and efficient manner. And I think those are the types of tools, if it's communication, giving good access to the clientele through a portal and using technology to benefit that. There just aren't the guardrails that you have in a bigger entity. And I think there are hundreds of examples, but generally speaking, it's a positive experience at the end of the day for the client, which is really what it's all about. And Jeff and Keith have used tools that I know are great examples of that.
I think maybe one of the relative examples is a software package known as Holistaplan, right? We're in tax season right now. We got a few days left. For clients who want some analysis done, right? True wealth managers also look at taxes and liabilities and, beyond just the assets, if you will, where this software allows us to perform a quick review and provide a summary of a client's tax return that is in-depth and offers proactive measures for that client to take. Once again, something we would never have access to out of the wirehouse, something that is approved and available to us here in our world, or something known as Riskalyze, right? Clients want to know what kind of risk their portfolios are under, what kind of risk they're taking with the portfolios you're managing, as well as outside assets. A software solution known as Riskalyze is something that is widely popular within the independent space and with our clients specifically, that provides them those details that, once again, we never had access to at our previous firms.
And I would just add, and Keith, from a managerial perspective, many of those tools are available at the wirehouse. It's just that they have guardrails put into place that in many cases you can't use the full range of services that are available. You may still get access to a financial planning tool, a risk tool, a tax planning tool, but in many cases they've stripped it down to really make sure that they manage the risk. And I think that's a frustration that many financial advisors have, is we can use that tool. The minute they step out in the independent world, they realize that they're only getting access to about 25% of the tools that firm may offer. That's just something else I would add. And I know that to be a fact because, we see it every day on that front. And Keith, I know you have a number of comments along those lines.
No, I think you guys have covered it. The only other thing that I would add is, on the tax front, it's an interesting one, right? Because clients get their tax return done. Their CPA sends it back to them and says, take a look and let me know if you have any questions. What do our clients do? They turn to line, 33 and say, what's my refund or how much do I owe? That's their tax review. And then they send off a check. And so nobody ever goes through their tax return with them. And even for us as advisors, we like to go through them, but it's a pretty time-intensive, tedious process. So this gives us a way to really visit with clients about their tax return, which their CPA doesn't do, their spouse doesn't do. So we can really provide some additional value by spending a little bit of time with them, going through a report that's very easy to prepare.
I think there's a lot of fear by financial advisors in the wirehouse, Keith, right? They're afraid to cross the line. They don't really know what the line is, right? And I think there's fear among many advisors, no matter how long you're in the business, and I saw it every day, where the advisors, many advisors do an incredible job at the wirehouse with helping clients. It's just that there's an uncertainty as to where they can draw the line with giving advice on things like tax or ERISA accounts or whatever it may be on planning or giving advice on assets held away. They want to do it. In reality, most of them are doing it. They're uncertain as to if they've actually crossed the line with what they're able to do with the firm policy that may be in place. And I think that's what I think most advisors can relate to. This is about how do we help our clients have a better experience. Advisors are extremely bright and talented, both in the independent space and at the wirehouse. There's no difference there. I think what happens, though, is that they're uncertain as to what they can and can't do many times, and they are afraid that they may cross that line and risk their entire industry and their career. So I would add that I do believe that there are some frustrations on that side with knowing what they can and can't do.
Okay, well, we have another question that's come in from the audience, and it's changing tack slightly because we are going to talk about succession planning. The question is about the benefits for an advisor that's planning to exit business in a few years as an independent versus at a wirehouse. So, can you address that point of like succession planning when you're kind of looking at exiting a business? What flexibilities you have as an independent versus at a wirehouse in terms of, making sure the clients have that continuous service?
I'm the oldest guy here, so maybe I should talk about that first. At the wirehouse, they've got a nice program when you retire to have somebody else take over your clients and pay you X amount of money over a certain period of time. That's the good news. The bad news is your choice of who those advisors might be is sometimes limited to who's in your office. And the structure of your arrangement is totally limited by the firm situation. So in the independent world, one of the things that we're all concerned with is taking care of our clients. In many cases, we've dealt with these folks for decades, and we have a very strong opinion about who do we want to have provide services to them in the future. So that's an important part. In the independent world, you get to make those own decisions. So we actually merged with another firm about a year and a half ago. It was 3 advisors. They'd been in business for a long time. And we had a lot of discussions about their clients, the kind of clients they had, the kind of advice they received, and so on. And so the other firm was able to decide they were very comfortable with us helping their clients. And if they didn't like us, they could have gone somewhere else. So that was part one. And then part two is they were able to negotiate a deal that worked for them. So you're not limited by the wirehouse arrangement. You can negotiate with anybody to essentially take over handling your clients. In our case, we ended up paying them roughly $2.5 million over time. And we had a clause that if business grew, they were going to get more money. And we're currently paying those advisors an extra $100,000 a year on top of our agreed on price, which I'm actually happy to do because it means the business has grown a lot. But you can't do those kinds of things at a wirehouse. So in a sense, you have your own business and you can sell it to whoever you want. That has advantages from a sales price, from a structure standpoint, and in many cases, most importantly, to make sure your clients are with somebody you want to have take care of them.
Yeah, I would just use one word: flexibility. You have the ultimate flexibility as a business owner, as an independent advisor, to try to structure a transition or a sunset in everyone's best interest, starting with the clients, so there's continuity, and then once again, so that everyone reaps the the financial reward that may come as well.
All that is incredibly important to advisors. You spend this, a career building a career in relationships with these clients, and the biggest thing that I hear from financial advisors that are still at the wirehouse, many of them have been part of a transition package where they are buying out a financial advisor that had left the firm. And the frustrations, not only on the advisor that left, there are restrictions on what they can and can't do, right? You can't come into the office, or you can, right? They exit the business abruptly. And in many cases, the restrictions on what it took to get the right person in place, in many cases, they were told, no, you can't have that person because they don't meet certain qualifications. We see people that want their children or relatives to come into the business, right? As Keith mentioned, they want to structure the exit in the way that the advisor wants to. And also you add on the tax benefits, right? Based upon your tax structure and your financial advisor, your accountant, there are benefits from a tax structure on how those payments are taxed, depending upon how you structure the deal. But it's about choice, right? It isn't an ordinary income decision that you're going to get paid a certain percentage over a period of time. People want their clientele to get taken care of, as Keith said, by people that they trust. And if you build an ensemble practice with the right structure of your business, you really can leave the legacy that you want to develop. And I think many firms really want to build an ensemble practice where they can have a long-term, you may want to stay in the business until your 80s, right? But within the independent space, if you choose to do that and you have the right structure in place, you're able to really lay it out the way you want. And if you want your family and your children, your friends to come into the business, you're able to put that in place. And then you can layer in other advisors that may be too small, honestly, to have a very good succession plan in place. That's the other subset. There's a massive amount of advisors that are probably too small to really have a succession plan. And those folks have no idea what's going to happen in their book when they leave. It might get thrown out to the entire office, and they don't want that. So I would say if you're an advisor that maybe is under $1 million in production at a wirehouse, you may not have much control over where your assets go when you retire. And that's another, your client, it's in the best interest of your clients to find somebody that will handle them in a manner that you see fit and that line up with your personality. So that would be another thing.
Excellent. Well, we are running short on time, but we have one more question that's come in. It's a really good one. So I'm going to ask Keith and Jeff to have a quick go at answering this. The question is, after an exhaustive due diligence process ahead of your transition to independence, what is something that surprised you once you were settled in the independent space? Keith, do you want to have a go at that quickly?
Yeah, that's easy. How much I didn't know. So you go through all this research and all this discovery, and then you make the decision. And at least for us in going with Kestra, they took care of an awful lot of things, right? They provide office space, they provide technology, they provide compliance. And yet there was still a bunch of stuff I didn't know about all these other areas. And I can't imagine if you went directly to a true RIA on your own, how much time and money you would waste for things you just didn't even know existed. So it's in the wirehouse, it's a very sheltered world. And there's all kinds of things going on behind the scenes that don't involve you. And once you go independent, or even in the Kestra world, there's a whole lot more going on that you get to make decisions about. And it's a lot to learn.
Mm-hmm. And Jeff?
Yeah, for me, I'd use the word ownership. Clients took ownership in our move to independence. Not that they didn't appreciate the relationship at the wirehouse, but they really we cemented so many relationships with the transition. Clients had a vested interest in our firm's success, and truly were happy for us that we cut ties with the 800-pound gorilla wirehouse firm and took the leap of faith that we went independent. So clients truly were happy for us and thrilled that we made that decision and took ownership in our overall success.
That's about all we've got time for. Thank you very much to everyone for watching and sending in your questions. They're really good. My thanks as well to Scott and Keith and Jeff for their insights. I hope they've been very useful to you.